What's up guys, welcome back to the daily stock picks, and in this video we'll be finding out whether to buy Apple right now at its current price. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and will be conducting my own quantitative analysis to see whether Apple either belongs in our dividend portfolio or our value portfolio by using this checklist. More on that later. And if you guys feel like being amazing, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. Now, without further ado, let's get this video started. So Apple is giving retail investors more reasons to take a bite. Apple stock is about to undergo a 4-for-1 stock split. So it already happened as per my calculations as of end of August 31st, 2020. This was written by Chris Markov. Apple, ticker symbol AAPL, recently announced a 4-to-1 stock split, which will become effective August 31st, 2020. This will be the fifth such split in company's history. Investors haven't been shy about piling into Apple stock in 2020. The stocks have posted an impressive 80% gain so far in 2020. But when you look at the stock's performance since the pandemic-induced sell-off, the stock is up over 120%. A good bit of this, according to Morgan Stanley Katie Huberty, was from retail traders. According to Huberty, retail traders on Apple stock during the pandemic has jumped up 25% compared to 10% in 2019. And now the stock split may be impetus for an even larger gain by the tech giant. Huberty also noted that every time Apple shares have split, the stock has outperformed the market. And this was not only prior to the stock split, but in the 6 months afterwards as well. So according to this writer, he's saying that after the stock splits, Apple stock generally appreciates within the next coming 6 months as well. Okay, now a new iPhone is coming. The stock split is coming in advance of a launch of the company's latest iPhone, the iPhone 12. This has been a launch shrouded in secrecy, but the most important consideration at this point is that the company is going to launch a new phone. As 2020 began, that was not as certain as Apple manufacturing facilities in Wuhan, China were under quarantine. But as China has come back, so has the schedule for the iPhone. Details are starting to emerge about the iPhone 12, which is arriving in October, from what is being reported. The iPhone 12 will have the largest display ever that will pair with the advanced camera technology that made the iPhone 11 such a surprise hit for the company. And there are numerous swirling that Apple may release the iPhone at a live event scheduled for September 10. That would be the same date the company released the iPhone 11 in 2019. But aside from that coincidence, it would fit a pattern. Apple enjoys under-promising and then over-delivering on the release dates for its products, specifically the iPhone. And while investors may be tiring of this pattern, they don't seem to have a problem buying the stock. And you gotta understand that Apple is valued over $2 trillion, right? And it's only the biggest investors, which is basically the institutional investors who control majority of 80% of all the stock market out there. They need to invest in such companies because they can't find companies that are of low cap because they will be influencing the price in such a manner, right? So Apple stock is a good market valuation or good market cap for these companies to invest, and there are like certain advantages for retail investors like us when compared to the institutional investors. But that's a topic for another discussion though. It may also help to combat sticker shock. According to the reports, the iPhone 12 will have a healthy $150 premium from the prior version. That is being referred to as the 5G tax, because that will be a distinguishing feature of the iPhone 12. While some customers may resist the premium price, Apple is largely jumping the competition and getting its 5G phones on the market. Apple is more than the iPhone. The iPhone remains the essential core of the business. However, in the last year, Apple is proving that service division is more than just window dressing. In the company's most quarter, the division posted 15% year-over-year growth on revenue of $13.2 billion. And the company is also seeing strong results from its wearables business, which includes the Apple Watch, that saw whopping growth. According to the company, over 75% of the Apple Watch purchases in the quarter were from people new to the product. The Apple stock split is an early holiday gift. I love my iPhone, but if I was debating between buying an iPhone or shares of Apple stock for Christmas, I would take the stock. In many ways, I look at Apple in a way I view Disney. Branding is not easy, but when a company does branding well, it looks easy, and that's Apple. They simply have an ecosystem that gives them a loyal, if not cultish following. But the reality is, loyal customers support Apple because the products work well and work well together. Simply put, they have managed to find a value beyond price that applies to Apple stock as well. This is a growth stock that is offering shareholders even more reasons to believe in its growth story. Okay. Now, in order for a company to meet my dividend portfolio, it basically needs to meet 4 rules. And my dividend portfolio is based upon these 3 books, which I highly recommend checking out, right? So here are the rules. Rule number 1 is that the current cash flows must be positive. So you want to be making sure that the company that we're investing in has positive cash flows, meaning that it is actually bringing in cash into the business rather than showing on paper like the income statement does. And rule number 2 is that the dividends paid out should not be more than 75% of the current free cash flows. So what this means is that companies that pay out a dividend, we need to make sure that at least 25% of the free cash flows is being retained by the company for the management to use in order to clear off its debt, or if anything comes in the future that the company might need money for. And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. But if you want to be more on the conservative side, you can look for companies that are more than 10 years. And rule number 4 is our buying criteria. So we only want to be investing in dividend stocks when the current dividend yield is greater than or equal to 5-year dividend yield average. Now looking at Apple stock, let's have a look. AAPL, ticker symbol. I like to use white charts because they do a really good picture representation of the financial data in a graphical format. As I'm a visual learner, I like to look at things visually rather than looking at numbers. So looking at Apple, let's type in ticker symbol AAPL into the spreadsheet. So we can see that Apple's current price to earnings ratio is 36.77, which is expensive than the S&P 500 index, which is 29.46 price to earnings ratio. Now, the free cash flows, we can see that the revenue has been increasing consistently along with its free cash flows, and the current free cash flow is $59.90 billion. So the free cash flow is definitely a positive. Now let's see how much amount of dividend is being paid out when compared to the free cash flow. So 14.12 divided by 58.90, you'll get that around 24% of the free cash flows is being paid out as dividend, and the remaining 80% is being retained into the business so that it can reinvest back into the company. So that's definitely a good sign. And looking at Apple's growth history, we can see that Apple has been increasing its dividends over the past 8 years at a rate of 10.50%. So that is an amazing number. Looking at it, just imagine you, just by owning this company stock, the company's management and the board is decided to pay you a 10% increase on your dividends, or like a check, 10% increase on your check year over year. Which is pretty phenomenal if you were to look at the compounding effect that it has in the long term. So definitely does meet the criteria, and the right time to buy this stock is when the current dividend yield is greater than the 5-year dividend yield average. If you were to look at this, we can come to a conclusion that it is on the expensive side at the moment, and it's 0.66. We want to be buying when it's at least 1.54 or more than that. Currently, looking at the valuation, it doesn't meet our dividend portfolio, and it does seem to be on the expensive side. So just for fun, if you were to look at the dividend yield average, you can see that back in May of 2019, the Apple dividend yield was around 1.66%. And if you were to invest in the company back then, just imagine that this is considering the stock split that has happened. So if you were to look at that in May of 2019, $52, you would have nearly doubled your money from around $52, which is now currently trading at $120.96. More than double the money in a span of a single year, a little bit over a single year. Yeah. Now, let's see if the company meets in our value portfolio. Now this time, according to my value portfolio rules, it needs to meet 5 rules, and these 5 principles are basically based on these 3 books that I read, which I highly recommend that you guys check out. So the first rule is that the return on invested capital must be greater than or equal to 10%. So return on invested capital is what I like to call the big brother of return on equity, because return on invested capital also takes into debt into consideration while calculating the return. So I will make an exception if the fundamentals of the business are pretty strong and I like the company's business model. But as a general rule of thumb, we want to be looking for companies which are higher than 10% or greater than or equal to 10%. So any number which is greater than 10%, that means that the company has a long-term competitive advantage. And rule number 2 is that it needs to have consistent net cash flows. So we want to be able to predict the cash flows from 10 years from now just by looking at the current cash flows and its previous trends. And rule number 3 is that it needs to have a strong balance sheet. So we know that generally companies take on debt in order to speed up the growth of the company, but we need to be making sure that the management is not taking too much that will be really hard for the company to pay off. And a good rule of thumb is that its long-term debt should be cleared off within 6 years or less than 6 years. And rule number 4 and rule number 5 are our buy principles or buy rules. So we want to be buying the company according to rule number 4, when it is at least at a 20% markdown from the fair price. We'll be calculating the fair price just in a few minutes, but that's what we want to be looking for. And rule number 5 is generally looked into if rule number 4 doesn't meet the criteria. It's based upon the price to earnings multiple. So if the current price to earnings multiple is less than 50% of the highest 5-year price to earnings ratio, we would be considered buying the stock. But another exception is that it needs to be cheaper than the S&P 500 index. Okay. Now let's have a look at Apple to see if it belongs in our value portfolio at the moment. So AAPL. So the current return on invested capital is 26.30, which is definitely meets our first rule in our value portfolio. As we've analyzed, the cash flows have been increasing consistently. If you were to look at this, it was around $16 billion 10 years from now. So 16 double is 32, 32 double is 64. So it's around 2 doubles, so around 15 to 20% year over year increase in its free cash flows. And looking at the dividends, we can predict that it's only accounting to 24% of the current free cash flow, so definitely a good buy. And looking at its balance sheet, we can see that the long-term debt is around $112 billion, which it can easily clear off within a single swipe with its current assets of $140 billion, so definitely a strong balance sheet. Now let's calculate the intrinsic value of the company. Now the current earnings per share is 3.288. And now looking at the price to earnings multiple at which it has been trading over the past 5 years, 9.917, 40.82. And the analysts at Wall Street are estimating that Apple could grow at around 12.46% over the next coming 5 years. So we'll be projecting this into the 10 years as well. Now, what we're doing with this calculator is we're taking this earnings per share, projecting into 10 years from now by multiplying it with the analyst estimates. And now, whenever we're using a conservative estimate, there's this earnings per share we need to be multiplying it with the price to earnings ratio, which we need to guess that the company might trade 10 years from now. Knowing that the company has a competitive advantage, we can either consider the price to earnings ratio, average price to earnings ratio of 25.37, or otherwise, you can multiply the analyst estimates times 2. That will give you the multiplication ratio. So we want to be considering the most conservative one because we don't want to be overshooting the estimates, right? And according to this, the intrinsic value 10 years from now would be around $235.76, and the fair price at which we should be buying the stock should be $67.02. And if you were to look at it by considering a 50% margin of safety, you should be buying the stock at $33.51. If not, you can at least take a buying position when it's at a 20% markdown of at least $53 per share. With looking at the current valuations, Apple is currently trading at $120.96, and I believe that it's currently overvalued. Please let me know what you guys think. Do you think it's overvalued, or do you think that we need to be looking at the stock from a different perspective? Make sure that you hit it down in the comments down below, right? Closing remarks of this article. Chris Markoch is a freelance financial copywriter who has been covering the market for over 5 years. He has been writing for Investors Place since 2019. On the date of the publication, Chris Markoch did not have either directly or indirectly any positions in the securities mentioned in this article. So if you guys have stayed around till the end of the video, I really appreciate it, guys. I just can't thank you enough. But just to let you guys know, full disclosure, this video is for your education and your entertainment purposes only. There is no guarantee that you'll earn any money using the techniques and ideas mentioned in this video. This is not financial advice. Please consult your financial or tax professional prior to making an investment in these companies. And if you guys really like this video, make sure that you subscribe and turn on the bell notification icon as we upload videos from Monday to Friday. And catch you in the next video. Peace.